Well, hello everyone. My name is Lucas Peters, and thank you for joining this episode of our Riskology series. Riskology is an educational series that we're doing here at Professional Ag Marketing. Comes out the third Tuesday of every month, and it's the point of it is to take a topic in risk management and do a little deeper dive and education on that topic, and hopefully spur some questions from you, the audience. And so we thank you for listening in to this month's episode, where we're going to talk about LRP livestock insurance. If you do have any questions as we're going through this presentation, or you listen to it and would like some more information, we would encourage you to reach out to Professional Ag Marketing. Check out our website, professionalagmarketing.com. Give us a call at 507-449-2030, or contact one of us or any of us at Professional Ag Marketing. So thank you for joining us, and let's go ahead and get started on the basics of LRP insurance. So our agenda for today will go through a little bit of the background on the livestock insurance program, talk about the specific product a little bit, go through the claims process, highlight some of the 2027 insurance year changes, which will go into effect July 1st, and wrap up with a little summary. So as we kind of start off, it always is a good idea, I think, to understand where a product or a program has came from and help see where it's going. So LRP and the LGM insurance products, LGM will cover in another Riskology series, but they were released in the early 2000s for swine, feeder cattle, and fed cattle. So you think about this product like LRP, I believe 2003 was the first year it was available. Been around many years, but really just here in the last few years has it gained popularity. DRP is Dairy Risk Protection. That was developed in 2018, so a relatively new product that took off. And the main reason DRP took off was it had an increased subsidy compared to the existing livestock products. Well, the LRP and LGM product got its subsidy increase in 2020, and since then, participation has dramatically increased on all types of LRP insurance. Now, all of the livestock insurance products, LRP, LGM, DRP, fall under the crop insurance umbrella. And what I mean by that is they are controlled or managed by the RMA, which is a branch of the USDA, so it is a government subsidized product. The government works with private insurance companies, the crop insurance companies nationwide, to offer these products. I believe there is 5 of the companies that offer livestock insurance nationwide, all the same price, because that is the government product. Just like crop insurance, if you buy the same coverage for the same type, then your premium and coverage will be the exact same no matter where you are buying it from. It also, because it's under the crop insurance umbrella, it has a lot of the same rules as crop insurance, as far as we need to track Social Security numbers and ownership, and we need an AD 1026 on file at the FSA office in order to qualify for subsidy. Like, that might seem like second nature to a crop insurance a customer, because they are used to dealing at the FSA office. If you strictly raise livestock or swine, for example, and you sign up to have an LRP policy, you may have never been to the FSA office and don't know what an AD 1026 form is, but you'll need to get one on file in order to get subsidy. So that is kind of just a little bit of a background on one of the questions I get is, why is this product very similar to crop insurance rules? It's because it falls under the same umbrella. I mentioned before, participation has increased dramatically. Let's look specifically here at a few of the different types of livestock and the growth that they've seen. So starting off here in swine, and this chart just shows the number of head insured for swine, depending on the crop insurance year there. So the subsidy increase went into effect 2020, late 2020, which would have been into the 2021 crop insurance year. So that's why that is the first slide there. And you can see 2021, 6.5 million head insured nationwide, which was a gigantic increase compared to the years prior. In fact, their years prior wouldn't even show up on the chart when you look at the numbers. 2022 was another growth year, a little bit of growth. In 23, they expanded the head limits in swine, and that's where we really saw the numbers take off. 2026 number, of course, we are still in the 2026 year, and this number is a little bit out of date, but it is expected that the swine LRP head insured will be down slightly 2026 versus 2025, but you can see a rapid increase on the number of head insured on swine. Swine was definitely the first one to see a rapid expansion into LRP. The next type there is feeder cattle. Feeder cattle have always been the longest, or I should say, the most popular type insured since the beginning. It really works well for cow-calf producers, and really similar trend to swine. Maybe we didn't see as sharp of an increase in the number of head insured, but definitely seeing an increase. And 2026 numbers will actually exceed 2025 by the time we get to the end of the insurance year, which is June 30th. Fed cattle is the next one. Fed cattle has been the slowest one to adopt LRP insurance, partly, I think, because of the way the LRP policy is set up for fed cattle, maybe not as advantageous as swine or feeder cattle, but also the fact that the fed cattle producers maybe traditionally have a little better risk management than a feeder cattle producer. So they kind of have a way they've been doing business for a number of years and haven't as taken to the LRP as fast. That being said, you can see it is definitely growing, and 2026 should have the highest head insured since the inception. We are off to a good start for 2026, or as we get closer to the end of 2026, I should say. And the fed cattle is one where I would pay attention over the coming years. The RMA wants more participation in the fed cattle program, and there should be some rules in place to improve the way the product works for producers, and that's something you'll see in our 27 changes and more likely in changes going forward too. The next slide there is on subsidy factors. So we mentioned that the big jump in LRP participation was when the subsidy was increased in 2020. So the subsidy was increased to 35%, that bottom number here on the graph. In that 100 to 95% coverage level, the coverage is 35% subsidized. Very advantageous for producers to use, take advantage of that subsidy, use the subsidy to save some money and still have downside protection if prices fall. You can see as the coverage level goes down, our subsidy factors go up. Very common in all of crop insurance. If you're going to take on more risk by buying a lower subsidy level, a lower coverage level, your subsidy is going to be increased. Typically, in our office on LRP, we will sell mostly into that top coverage level range of 95 to 100% and qualify for that 35% subsidy. Some other basics on LRP. LRP is the easiest way to think about it is that it is a subsidized put option. It is putting a floor on the price of your swine or cattle. It only protects price. There is no coverage in there for mortality or weight gain or death, anything like that. Strictly price and price going down. On swine feeders or feds, it is available for sale roughly 3 p.m. in the afternoon until 8:25 the next day. So it is not open, not for sale during the trading hours. When the market is open, it opens up after that. So again, roughly 2:30, 3 p.m. in the afternoon, for sale through the afternoon, evening, overnight, up until 8:25 the next morning. So that is a really key benefit of LRP in the world we're in today of 24-hour news, tweets, truth social messages going out at all times of the day and night. If the market is closed, there may be an opportunity to protect a price using the LRP product. We should not ignore that advantage. Not necessarily always the best risk management to be reactionary to a tweet you saw, but at least we have that availability if the news comes out. That being said, it is controlled by the USDA, and they have the ability to pull LRP coverage and make it not available for sale if they think that the news or there's something being released that warrants the offers being pulled. That has never happened, and hopefully never happens going forward. There are many coverage levels available. We talked about that with our subsidy, 100% coverage level down to 70%. The coverage level, the coverage, the dollars protected for the customer are based on the coverage level, the price for that day, and the head and the weight that the insured chooses to insure. The actual price received by the producer does not come into factor at all into the LRP. So that is I don't know, it's a little bit of a blessing and a curse, right? It's nice that you don't have to disclose what you actually received for your livestock for the price. Maybe when you were selling, it was very advantageous and your price was higher than where the board was at. But that does not matter at all for LRP. It's going to settle to either the feeder cattle index or the 5-state area cash for the fed cattle or the lean hog index for swine. And that's where your LRP coverage is going to settle to, not what you actually receive. A few other things to consider when we're looking at LRP. So these are some of the things the producer has to choose. You have to choose how many head you're going to insure. That is nice because there are no minimums. Okay, so if you want to insure one or a couple head at a time, or maybe you're a small producer and only have 5, 6, 10 head of cattle, you can insure those. You choose the length of coverage you want. So there are different intervals available for LRP, ranging from 13 to 52 weeks. So roughly about every month, there is an LRP offering. The soonest you can do is about 3 months out, that 13 week, and then there should be an offering available every single month up to a year out. Now, there's not a year out available on every type every single day, but that for our swine, feeders, and feds, these are pretty common availabilities. You have to choose your coverage level. I mentioned we usually use the top coverage, the 100% coverage level most often, but you can choose anywhere between 70 or 100%. And then you choose your target weight at the end of the coverage. Wherever you think your livestock are going, whatever that you think they're going to weigh at when the LRP coverage expires, that's the weight we should insure them at. We have to, if there's a claim, we'll get into a little bit, we have to show the kill sheets, the sales information of those livestock. And if the weights are considerably off from where we entered them when we bought the coverage, there could be an issue. But otherwise, they don't hold us to those weights real tight. As I mentioned, there's no minimum head requirements, very good for small producers. There are maximum head limits, but they are very high. And so that, for example, swine is 750,000 head per year. Cattle are 25,000 head per year. So our head limits allow for a high number of producers and producer sizes to utilize this product to their advantage. Mentioned the subsidies at 35%. Another advantage of LRP is the premium is not due up front. So you do not pay for any of this coverage until 2 months after the LRP coverage is over. So very friendly for cash flow purposes and nothing due up front when coverage is added. Our coverage is offered, say every trading day, more or less. It is not available on days that like a cattle on feed report is released, a hog and pig report is released. On those days, there is no offering for that respective livestock. Otherwise, it's available every single day that the market is open, and the coverage price or the available prices for that day will be based on where the futures contract is trading at. Okay, so a 100% coverage level LRP should be very close to where the futures contract closes that day. The settlement, where we end coverage, that is based on the lean hog index for swine, the feeder cattle index for feeder cattle, and the 5-state area cash over 80% choice category for fed cattle. So we'll look at the day the LRP expires and pull the index or the 5-state area number for that day. And that's how we will calculate your ending coverage and determine if there is a claim. So I think this comes together a little bit better if we look at our quote. And so I have an example of some quotes there. These quotes are from a previous day, not actual today's quote, but they do a good job of showing you how this works. So you can see our different intervals there, our 13 through 30 week, for example, on this slide. Another point on swine is 13 through 30 weeks. We can insure without sow ownership. If we're going to go 34 through 52 weeks, in order to insure those pigs with swine, we need to show some sow ownership. On our coverage levels, you can see we do on our quote. This is a quote that we run and email out every day from Professional Ag Marketing. And if you're interested in receiving it, by all means, send us a note and we'll get you on the list. But we do compare our quote to the corresponding put option premium in order to show the value of what the LRP is giving you. They don't match up perfectly, but at least we have an idea of our savings that we're using or getting by using LRP instead of a put option, since those products work very similarly. The next one there is just another hog slide, again, going out through 52 weeks. The feeder cattle, another just example, but kind of showing, again, the value of that LRP. As feeder cattle prices have increased and the put options have gotten more expensive, the value of the LRP really shines. And so you can see on the screen there, it's not uncommon for the feeder cattle LRP to be $4 to $5 per hundred lower cost than the corresponding put option. So a good value by using LRP if it fits your operation. So a few other claims slide there. For claims, if we do have a claim, we have to show the number of head insured in order to receive our claim. Okay. So there is no speculation allowed in the LRP or LGM products. They have to show sales. So we on swine and fed cattle. Feeder cattle, we do not have to show the ending or final sale, because maybe we're going to keep those feeder cattle back and finish them out to a heavier weight. So it does not require us to show sold records for feeder cattle. I often get asked the question of, do I have to have my livestock sold by my LRP end date or on the LRP end date? No, you do not. So that end date is simply when your coverage is going to end and be calculated if there's a claim or not. Ideally, we would like our LRP ending value to be close to where our livestock are going to be sold so that we have good coverage. But we do have a big window. So we can count livestock towards our LRP coverage that are sold between 60 days before and 60 days after our LRP end date. So lots of flexibility in there to market your animals when you want to and not be really controlled on when the LRP expires, but also not so stringent on when you're adding the LRP that you have to match up with your sales date. So we got a nice window there to protect that. The ending values generally come out 10 to 14 days after the end date is reached. That's when we'll get a form as the agency and send it out to the customer for their records or to sign for a claim. The next one there, 27 changes. So the something that every year around the end of April, they release the changes for the program for the year. LRP works on the crop insurance calendar, meaning the new year starts July 1st and it goes through June 30th. One thing I forgot to mention before, and I'm going to mention it now before we get into the changes, is you are only allowed to write LRP with one agency per year. So if you have a policy, you have one time of year to change it, and that is before July 1st. And think of it, if you're on the crops side of, that's our March 15th sales closing date for our corn and soybean producers. That's their renewal time or time to transfer or change coverage. July 1st is that date on the livestock side. So keep that in mind if you have a current LRP, that we need to get it renewed before July 1st or transfer to a different agency before July 1st. Now, a few of the changes, last year they came out with a lot of rules around subsidy capture to prevent some potential issues or advantages that were being taken place in the LRP program. They added a few more clarifications on the practices considered to be subsidy capture. If you have questions on that, please talk to an agent or talk to myself here at ProAg. A big change, big positive change for 2027 is they are allowing concurrent coverage between LRP and LGM. So before, I could not have an LRP expire in the same month that I have an LGM expire. And LGM, again, covered in another Riskology series, but those products work a little differently, and there's times for a producer where we want to use both. For example, for a cattle producer, we might use feeder cattle LRP with fat cattle LGM, and obviously these are insuring different cattle, but before 2027, we couldn't have those ending in the same month. So it created a little bit of confusion, some problems. So they corrected that. Good thing. The one little bit of a point there that's going to drag this on is we can't do it until both policies are for 2027. So if I have a 2026 policy ending in a month, I cannot write a 2027 LGM or LRP policy in that month yet. Once 2027 hits, then we can do it both. Policies will be automatically canceled after 3 years of not earning premium. That is a nice change for those, what I call orphan policies, of maybe we signed up somewhere and forgot about it. And now that'll automatically be cleaned up here again going forward. Not something that's going to happen right away. And they also increased the max weights. So on fed cattle, LRP, before we could only insure up to a 1,600 pound animal. In 2027, we're able to insure up to 1,800 pounds. On feeder cattle, one of the things we can do is insure unborn feeder cattle, which is very advantageous for our cow-calf guys. Before we were limited to 6 weights on those. Now going forward, we can go up to 9 weights. So not a lot of changes for the coming year. I think that's one thing that you'll see in these products going forward is they are maturing. And the first few years, we had significant number of changes. And now we're just kind of tweaking a little bit here and there of the weights or being able to write policies that end in the same month and hopefully improve the experience for the producer going forward. So with that, I don't have a whole lot else, but I got a little summary slide there at the very end. These livestock products are not a silver bullet. They are very advantageous for the producer with a subsidy. They can be a great tool to implement into your overall risk management plan, but you do want to know how they work, how they fit with the other risk management tools that you're using. There's certain times of the year where it's advantageous to use LRP, and there's certain times of the year where it might not be your best option. And I think that's kind of getting to that bottom point there, is working with an agency that sees the whole picture, that is in the market every single day, looking at quotes, looking at times of the year, looking at when we should pull the trigger on adding an LRP policy is key going forward into making sure these products best protect your operation. So with that, thank you for joining us. And if you do have any questions, please reach out to us at Professional Ag Marketing.